So, hey guys, welcome back. Hey, it's your host, Josh Cantwell. Thanks for jumping on and listening and participating and being a part of the community. Today, I have a special guest on the show. His name is Andy Hagans. He is the co-founder at Wealth Channel, a leading community for high net worth investors and advisors who place capital in alternative investments. He's also the host of the Alternative Investment Podcast, the #1 alts podcast reaching RIAs, family offices, and high net worth investors. He's also the host of the Wealth Channel live events. And that is a platform where they bring in accredited investors, high net worth investors, and match them up with sponsors that have alternate investments. Could be private equity, could be venture capital, could be real estate syndications. You name it, they want to focus on alternate investments. And today we're going to talk about #1, how to pick a winner, how to pick a general partner or pick a winner, pick an investment if you invest in alternatives as a limited partner. They must, #1, have a proven track record, and #2, must be a space that they understand. #2, we're going to talk about crowdfunding and how to start investing in alternative assets through crowdfunding. We're going to talk about #3, what's called the illiquidity premium, the idea of earning higher returns in alternative assets because they can be illiquid, like real estate, oil and gas, cannabis, crypto, private credit, things like that. And also why financial advisors have pivoted from the traditional 60-40 diversification model to a 50-30-20 model, including alternate investments. You're going to love this episode of Accelerated Investor with Andy Hagans, the CEO and president of Wealth Channel. Here we go.
Welcome to the Accelerated Investor Podcast with Josh Cantwell. If you're looking to retire early with forever passive income, you're in the right place. This podcast is the go-to destination for real estate investors, both active and passive, and multifamily apartment investors, both new, intermediate, and advanced. Now, sit back, listen, learn, and accelerate your business, your life, and your investing with the Accelerated Investor Podcast.
So, hey, Andy, hey, welcome to Accelerated Investor. I'm so excited to have you on the show to talk about some alternate investment opportunities and talk about, your kind of view of the marketplace based on what's going on. So thanks for carving out a few minutes for the show.
Very happy to be here. I love your show. I know you have a big thing going here, so I'm just happy to connect with you and your audience.
Absolutely, Andy. So let's talk about alternatives a little bit relative to today's market. The market's weird. Let's just do a quick recap. A month ago, the 10-year treasury was up at 4.2. A lot of people were saying that the cost of debt was becoming very prohibitive to be in business or to be a real estate entrepreneur, to start a new company. All of a sudden today, the 10-year treasury is down to 3.2, which is allowing the cost of debt to be more affordable, which will probably create some more transaction volume. There's all this talk now about China going in and buying and contracting in oil with Saudis and Russia in the yuan, and the US dollar losing value because of inflation. Your focus is alternate investments. And so if you look at today's market, what are you most excited about or most concerned about?
What's really, you already kind of mentioned them, Josh, and they're almost the same thing, or they're two sides of the same coin. What I'm most concerned about is financial repression. You mentioned the 10-year being in the low threes now, and inflation is in the 6 or 7s, or, kind of depends on who you ask if you trust the CPI or not. But investors are looking at this entire category in traditional investments, fixed income, and on an after inflation, after tax basis, it's very negative, right? So that's financial repression, where the earnings that you can earn in any reasonably safe fixed income are actually negative after inflation. So what I'm most excited about is kind of the other side of that coin. So you add in financial repression with fixed income, you add in the extreme volatility in the stock market, more and more investors are shifting into alternative investments, and that's my wheelhouse. That's what I'm passionate about. That's what I'm excited about. And honestly, family offices, institutional investors, Harvard and Yale endowments, some of the most sophisticated, ultra wealthy investors have been investing in alts for decades now. And it's finally, to me, it's like it's the moment of alts when it's finally kind of hitting the mainstream where, if I could use the phrase everyday millionaires, or, your kind of everyday accredited investors are really embracing alts.
So define alts for me. What for our audience, like in your mind, Andy, and what you like to invest in or talk to your investors about, and you investing your own personal dollars in alts. Define that for us from your perspective. What does that mean to you?
So, it's funny, you can ask 100 different alternatives experts, get 100 different answers. But to me, anything besides stocks, bonds, and cash or cash-like instruments. And when I say stocks and bonds, I'm also including in there traditional wrappers like mutual funds, index funds, ETFs that own those instruments in like a long-only fashion. So anything besides those, to me, is an alternative investment. So everything from, collectibles and commodities and precious metals, to also things that are in funds, in products like private equity funds, private real estate funds, venture capital funds. And so it's really, my focus is more on the latter, is on alternative investments that yield income. Because I mean, perennially, I find income is popular. It's popular with me, but it's popular with everybody, right? Institutional investors, family offices. And so to me, that's kind of my sweet spot, is alternative investments that don't have the volatility of the public markets, that yield substantial income. They tend to also have, most of them have very attractive tax advantages. I know you have a lot of real estate investors in your audience. So that's kind of my wheelhouse: private equity, venture capital, and private real estate.
Got it. Love it. So if you listen to like Robert Kiyosaki, he's become more and more bearish on the US economy, the dollar, and talks a lot about the same things that you're mentioning. But he's been that way, says he's been that way forever, right? He's been anti-stock market, looking at alternate investments. So most people probably are still, a great percentage of their wealth is in the stock market, traditional stocks, bonds, mutual funds. If you're talking to one of those people that's a reasonable net worth, high net worth investor, but still is doing traditional things, maybe they own a business, they're making a couple $1,000,000 a year personal income, they've built up, a stock account that's worth millions, and they maybe have a business of their own that they run. Mm-hmm. What's the first step for them? Like, what is the first thing that you would talk about with someone like that to talk about alternative investments? Is it the tax advantages? Is it the risk? Is it de-risking their portfolio? And then what's the first thing that they should look at from your perspective? Is it real estate? Is it investing in, industrial real estate, multifamily real estate? Is it investing in a business, like an e-commerce business that can be taken over, that's maybe being sold at a discount? So first, let's talk about the person that's got most of their money in traditional investments, and what first steps should they take to begin looking at alts?
Yeah, that's a great question. And to be clear, I don't coach people like liquidate your whole traditional portfolio and put it all in alternatives. I still own traditional investments. I'm a big believer in diversification. But that being said, kind of a starting point, I would say, the old 60-40 portfolio, even a lot of advisors, traditional financial advisors, are now talking about the 50-30-20. So I think step one is just sort of, looking at your portfolio and saying, well, what do I own right now? What's my asset allocation right now? And what do I want it to be? And to your other question, what's the primary appeal of alternatives? I mentioned income, but I really think more and more it's capital preservation. I think a lot of investors are turning to alternative investments because they're sick and tired of the volatility in the public markets. And so by investing in some of these illiquid funds, people talk about there's illiquidity risk. To me, illiquidity actually helps me sleep at night, because like, let's take a private equity deal that I've done. I'm a partner in a private equity business, general partner and limited partner, and I just own the business, right? And so it cash flows, and I get basically a monthly dividend. there's no stock market that's repricing it every single day, making
Right.
me nervous. But so to me, if you think about illiquid alternative investments, is that the kind of lifestyle you want? Passive income without necessarily having to check your balance every day. And some investors might say, you know what? I don't care if the stock market's on this wild roller coaster. I'll check my balance when I'm 65. And if that's you, like that's fine. But increasingly, I think a lot of high net worth investors, they're interested in alts because of that capital preservation aspect, less volatility. And then those other things, income, tax advantages, those are like sweeteners that make it even more appealing.
No doubt. You mentioned that you're in a private equity business. So if somebody says, hey, I want to get started in alts, real estate as a limited partner, general partner. We've talked about that 100 times on the show, right? And then people are like, okay, yeah, we know about those opportunities, and we've raised about $100 million and we know about those. So outside of real estate, let's go down a different path. Describe an investment or investments maybe that you've done that our audience could be aware of. Maybe that exact investment's not available anymore. It's maybe fully subscribed or sold out, or you're not raising any money for it. But describe a couple of those for us. And then high level, generally, how would somebody get access to a deal like that?
Yeah, that's a great question. And, with all of these, I think with private equity or with real estate, and by the way, I mean, private real estate and venture capital are really technically subsets of private equity, right? Private equity is just equity that's private, that's not publicly traded. But there's a spectrum of how active do you want to be versus how passive do you want to be. And so my personal portfolio, my personal alternative investments, they're actually across that spectrum, right? So I have some investments where I'm just a totally passive LP, like in a private real estate fund. A couple private equity deals that I'm involved in. One is a venture capital fund. Okay. And that's a deal that I got access to. Just someone I knew the GP and he knew of me, and we just had a relationship. And actually, I think they had a pretty high minimum, but just because we had a relationship, and I don't want to say I did him a favor or anything, but we've just helped each other kind of over the years. So he invited me in to be an LP into that fund. But there are other venture capital funds that, they might have $100,000 minimum, a $250,000 minimum, $500,000 minimum, that you can just be an LP, without any sort of invitation or anything like that. That's the purely passive end of the spectrum. Probably my best deal to date in private equity was on the more active side, right? So, in the real estate world, this would be more like being a GP or being a GP LP or co-GP. All these terms we throw around, they kind of confuse people, but basically, if you're a GP, a general partner, you're active in the deal, right? You're adding value somehow. Maybe you're helping with the management. So this was a company, a fintech company in the payments processing space. And I basically made an early investment. And I also offered to help them just strategically because, I'm familiar with marketing and some different ways to scale businesses because I've done that in the past. And so this has just been one of those quiet, boring businesses that it's had, some little ups and downs, but it's just kind of consistently grown over 5 years. And I've never even looked at the numbers, cash on cash, but I've done very, very well with it. And again, that's an investment. I wrote a check once. And then it's almost like mentally you write off, if you write a check like that into an illiquid business, you write it off. And I've never really had to worry about it again in the sense of like when the S&P is down by 20%, it's like, it doesn't affect my private equity investment.
And how did you evaluate that? Like you got access through a friend, you said it was an early investment, but what were some of the traits of that deal that you liked? Was it the way that they were gonna grow? Was it, did they have a unique niche in the market? Like if I had never, let's say I'm worth $10 million and I've got $1 million deployable liquid and I want to look at something similar, and I just don't know about making that first investment. What are some things that you saw in that kind of hit your checkbox, that hit your checklist and said, yeah, I like it? Tell us about that. Help our audience understand a little bit about what you think goes into a good deal like that.
That's a great question. And I think there are fundamentals that apply to any niche, whether it's real estate or private equity. Number one is proven track record in a partner that you trust, right? If I'm talking about doing a deal or investing in a fund, if I don't trust the principals, the GPs, just walk away. Like, I don't care what projected IRR is. It's just, if you don't have that trust, walk away. So this is someone that I knew, and they had a proven track record. So it's not just a track record, like in the abstract. I look for someone who has a track record in the space in that deal. So for instance, if I'm investing in a multifamily fund, I want the GP to have a track record in multifamily, right? Like, I don't want to be their first rodeo as a limited partner, to sort of use my cash for them to be their learning cash. So track record, sponsor that I trust. And then I would also say a space that I understand, right? And maybe I don't understand every single nook and cranny, but for me, online marketing, fintech, recurring revenue business models, those are things I'm very comfortable evaluating. And so, I think if you're in a space where it's very hard for you to evaluate what the sponsor is doing, to me, it might be a great deal, but if I can't understand it, then I'm just not comfortable writing the check. And I think that's why a lot of folks are attracted to real estate, and even like some spaces in real estate, like multifamily, because they're easier to understand. There's nothing wrong with that, by the way. Boring businesses that you understand can be fantastic businesses.
Yeah, absolutely. The businesses, and you mentioned the diversification. So when you said 60-40, like, people that have worked with an advisor or have their own portfolio, 60-40 stocks, bonds, that type of thing. Then you mentioned 50-30-20. What did you mean by that?
So 60-40 would be like a 60% stocks, 40% bonds or fixed income portfolio. That's like a traditional either retirement portfolio or institutional portfolio. That's almost considered to be like the default portfolio in the abstract with traditional investments. So the 50-30-20 is basically in the financial advisory space. A lot of folks there, financial advisors, RIAs, financial professionals, are basically saying, look, the new default portfolio has a 20% allocation to alternatives. And when they're talking about that 20% allocation, I mean, that could really mean anything in the abstract, but I think the biggest slices of that would be real estate, would be probably the biggest, that's the biggest sub asset class within alternatives, if you want to call it that, although it's an 800-pound gorilla. But then also, venture capital and private equity would be in that 20.
Okay. Got it. Love it. So you mentioned that you were able to get into that deal because you knew the sponsor, had a relationship with them. If somebody doesn't have that yet, where can they go? What can they do to meet possible sponsors, to meet possible partners, maybe other GPs that have a deal? They're going to do a raise and give up some equity, and they're going to the next level. I'm partially asking for my audience and partially asking for me, because I'm always looking for the next thing, right? And I've got a big piece of my personal net worth is in real estate, and our 4,000 units of apartments. You can do the math; it's pretty big. But we've done some things even within, like you mentioned, spaces that I understand. For example, we started a laundry business, right? So buying the laundry machines that we could put into our apartment buildings and other people's apartment buildings, without giving away too much. You can buy a set of laundry, give you an idea, a washer and a dryer for about $1,500 a piece, about $3,000, right? If you buy that and put it in a garden style apartment, let's say there's between 12 and 18 units in that garden style apartment, let's say 15 to use a round number, 15, that washer dryer should make about $20 to $25 per month per unit. So 15 units times $20 a month, right? It's not a ton, but it's $300 a month in income. They're brand new washers and dryers that have zero expenses because they're brand new, very little maintenance, very little overhead. And I can essentially make back the entire purchase of the washer and dryer in year one. That's a boring cash flow play. And there's huge companies, Laundry One and CSC and these other companies that have been in this space. But as they've gotten huge, and CSC is $1 billion company, their customer service with their owners, the apartment owners, has gotten horrible. And so a simple play there, that would be like a private equity type of play where a guy like me maybe says, hey, I'm going to go buy 1,000 of these washers and dryers, and I'm going to go approach multifamily owners, and I'm going to stick these new washers and dryers in there, and we're going to do a rev share or a split with the owner. And then you're not necessarily in real estate. You're essentially leasing out the laundry room. And this plays out to be about a, on a larger, we just cut a check for $100,000 to buy all these washers and dryers. And we anticipate to make, almost all of our money back within the first year, and definitely within the first 2 years. And even thereafter, about a 20% return for the company and a 20% return for the apartment owner on a rev share. Like, that's a private equity deal, right?
Totally.
Now, you couldn't get access to that unless you knew me, right? Same thing. Like, if I wanted to get access, is it being in the right rooms? Is it being in the right masterminds? Is it networking with those groups? Is it going to specific type of events? How do I meet more people that have access to deal flow like you do and I do?
That's a great question. And I mean, the scenario or the business that you described, it's almost towards the entrepreneurial end of private equity. As I said, there's a spectrum between LP and GP, and spectrum of how passive versus active you want to be. Sometimes there's a sweet spot, right, where you can get a little bit of GP and still be mostly passive. I love that sweet spot. How do you get access to the deals? You mentioned masterminds, you mentioned events, you mentioned networking. My big thing is skin in the game, right? Mm-hmm. So you're talking about your network and your partners, your investors, people you invest with. I think the biggest thing that blocks people is getting started, is taking a little bit of risk. So like, because it's scary, right? Like this venture capital fund that I mentioned earlier, this was the first venture capital fund that I've ever invested in, right? And it's like, I'm not a venture capital expert, but I trusted the person running this fund. Now I could lose my money, right? So I didn't invest like my whole life savings into this fund. I made a decision like, okay, this is an amount that I can afford to invest here. But once you have skin in the game, and skin in the game doesn't necessarily just need to be a check. There's different types of skin in the game, but showing up in person to events, joining a mastermind, that's generally going to be fairly pricey, in the grand scheme of things. It might have fantastic ROI, but that's an investment. Once you have skin in the game, I find people take you so much more seriously, as well they should. That's generally how I look at potential partners. That's like question one is do you have skin in the game in this industry, in this deal, in this community? And so I think that the thing that blocks people is just getting started, like in real estate, the first deal. So my best advice to people is get started, whatever way you're comfortable. Could be the smallest check that you can possibly make. It doesn't matter. Just get started, get skin in the game.
Are you ready to automate and explode your real estate investing? We're searching for extremely motivated individuals who are sick and tired of wasting time and want to finally see real results from their real estate investing business. We're searching for investors looking to get to the next level and become a bigger, better version of themselves while being a more successful real estate investing entrepreneur. Apply for mentoring and coaching at joshcantwellcoaching.com/podcast. That's joshcantwellcoaching.com/podcast.
Andy, do you believe in like the fintech firms that allow people to make relatively small investments, like $5,000, $25,000 to get started? Because look, I've worked with guys that have, multiple 8-figure and 9-figure net worths. And sometimes if they don't know the space, but they like the idea, they're like, I'm going to start really small. And often they go bottom seeking on what's the minimum. How much is the minimum? How much is the minimum? Because they just want to get a little, like you said, get a little bit of skin in the game. And then as they see it, they understand it. Now they kind of open up the checkbook. I had a guy that started with me with $50,000 who's now into us for about $1.5 million. That's very normal, right? Mm-hmm. So do you believe if somebody's got smaller dollars, they might be accredited, they might be worth $1 million, couple million, but maybe they're still making their first investment in a space. It could be venture. It could be, there's these online portals now where people can log in, they can see deal flow, they can pick a deal. It could be a real estate deal, could be a business, could be a rescue deal, whatever, and make some small investments just to like dip their toe in the water. Have you done that? Do you believe in that as a possible starter?
I do, for sure. I mean, to me, there's almost no wrong way to get started, right? The important thing is to get started. And so like there's all these crowdfunding portals now where you don't have to be an accredited investor. And to be clear, I 100%, support that. Like I love it when all these alternative asset classes, have improved access to all investors, not just accredited investors. But I will say, if you really want to learn a space, start in whatever way is comfortable for you, but you really want to get as much skin in the game as you realistically can. So for instance, take real estate. You might, instead of writing a check to a crowdfunding portal, maybe you can directly own a property with a relatively small amount of money, depending on your budget. You're probably going to learn a lot more that way. So again, I'm not poo-pooing the crowdfunding portals. I do like them. But if your goal is to learn and to improve your skill set, you need to think about, this isn't just an investment with my money to get dollars and cents back. I'm also treating it as a learning experience. Like I'm going to go get my MBA in this asset class by making an investment and learning about it.
Yeah, love it. Andy, tell us about your wealth channel. It's a community for high net worth individuals investing in alts. Tell us about that. And then peel back the onion a little bit and tell us how you personally got started investing in alts. Everyone loves to hear the journey, the process, especially for those people that want to make the leap and invest in their first alternate investment, but haven't done it yet. So tell us about the channel now, because now you kind of lead and run this community of high net worth individuals investing in alts. But you also started with your very first deal at some point back in the day where you weren't the expert and you were kind of probably really nervous and not really sure where to begin. So tell us about the channel today and tell us how it all started.
Yeah, no, that's a great question. And I never thought that I would be here, 10 years ago. So I almost think it's better to start at the beginning. So, I didn't start out in financial services or anything like that. In Wealth Channel, we run events and education on alternative investments to help educate high net worth investors. But where we started, my partner, Jimmy Atkinson, and I, it started in our dorm room. So I was 19 or 20 and he was a year older because he was a class, ahead of me. And we started our first business together. And that business grew into another business after we graduated that we scaled. It was online business, online marketing business. We ended up selling it. And then we built another business and scaled it and sold it and built a third business. We built one of the businesses we built was called ETF Database, which at one point in time was the largest independent media property covering exchange traded funds in the United States. So we kind of built these series of businesses. And, as a lot of entrepreneurs do, when you're building a business, you're kind of imagining building it really big and having a liquidity event, right? Selling it and kind of having a big payday. Well, we did that basically 4 times. And every time it's like you get a check or a wire, and you're like excited, you get a dopamine hit. And then 24 hours, it's like, now what? And after we did it the 4th time, literally, I must be kind of thick because it took me several times to kind of learn this lesson. It's like, now what? And, you'd take some of the proceeds of the sale of that business and you'd invest it. And at that time we were investing in index funds and in ETFs. You put it on the S&P and the yield on the S&P is 1.8% or 1.6%. And it's just like, what the heck are we doing? Because the yield and the return on these traditional investments, frankly, is terrible. In the bond market, as I mentioned, financial repression, after inflation, or if it's in a taxable account and you're paying taxes on your bond income, it's negative yield.
Yeah.
So we started saying, okay, that's what led to my first private equity deal where I invested in this fintech firm. But we also started looking at, and Jimmy and I, we kind of stayed in contact because we've been business partners throughout these deals. We started looking into other forms of investments that just yielded higher. They in academic terms, they call it the illiquidity premium, right? Which is why Yale and Harvard endowment do this, why they invest in private real estate, private equity, venture capital. They're just fundamentally better investments if you don't need the liquidity, right? If you need the liquidity, if you're going to need cash in the next 24 months, then don't lock it up in private real estate for sure. But, once you reach a certain level of wealth and assets, how much liquidity do you really need, right? So we just started investing in deals and all sorts of different funds. And so I didn't really seek out to be like an expert in alternative investments, but it's more just I've had this 10-year crash course by just sort of doing it. And, so the lessons I've learned, I've kind of learned them the hard way. To be honest, I've made lots of mistakes, I can be honest about that, but I've also had some big successes. And a lot of times, the wins in real estate and some of these asset classes more than pay for the losses. So bringing us to Wealth Channel, Jimmy and I, we have this kind of small community of other entrepreneurs and investors that we're networked with. And Jimmy and I, we both started podcasting, just talking about this stuff. And we decided, let's form a community around it where we're podcasting, we're releasing this education. We're also going to start to run events. And so at our events, which are totally online, we are essentially matchmaking accredited investors on the one hand with alternative investment opportunities on the other hand. And these are opportunities that are meant for accredited investors. They typically have minimums of $50,000 or $100,000 or, something like that. But private credit, private equity, private real estate, of course, those sorts of opportunities. So, you asked earlier, how do you get started? Coming to one of our events. If I could talk my book, coming to one of our events.
Shortcut, man. Let's just go to one of your events and learn it all at the, over a day or two or three. That's great.
Yeah, absolutely. And, sometimes there's just, you could go to an event and get pitched like that. That's kind of the whole concept is you can show up and in one day you're going to hear presentations from 12 or so different private funds. And they could be all over the place from private credit. You might see farmland. I'm sure you'll see multifamily at most of our events. There's multifamily. It's always a favorite asset class for good reason. And so you can kind of just
cannabis, different types of senior secured debt funds, mezzanine debt funds. There's a lot of different types of capital that's out there that, people can maybe go to the bank for a certain amount of money. And then there's the next tranche, the next part of the stack that maybe comes in a year or two later, or maybe it comes in simultaneously that the bank doesn't want to fund, right? And maybe because it's slightly higher risk or considered a second position, the interest rates or the returns are much higher where you can get maybe a fixed rate plus equity or something along those lines. As long as you said, again, go back to having a proven track record with a proven operator in that space who's in that deal. That's what I wrote down. And they understand the space, or you understand the space. Then you're like, okay, I get the space. I get this operator. I know what they're going to do with the money. The uses of proceeds is very important. And that's obviously in the PPMs for real estate. But man, I mean, when you look at what's happening with the economy, you look at what's happening with inflation, you look at what happened with traditional investments, the volatility, and so much even of the S&P 500 or the Dow is based off of big mega tech right now. There's not a lot of yield in other places outside of that, but mega tech is also extremely volatile. You can easily be down 30% right now in that investment from a year ago and be eating 6.5–7% inflation in the face. So you're actually almost down 40% on that money versus, am I going to buy some cash flowing real estate or buy a senior secured debt fund that maybe pays a 6 or an 8 or a 10 pref plus equity or plus some other benefits to that, plus depreciation. You're not only outpacing inflation and preserving your principal, but you're also out of the market where, and I think this is one of the things that just still blows my mind is that when I was in the financial markets in 2001, and companies like Enron literally went from billions of dollars to zero overnight. And Qualcomm, I think, was another one. There was a few back then that people literally, I had investor friends of mine, clients that had hundreds of thousands of dollars in those literally. And within a week, the thing went down to zero. And it's something like every year, 6 out of 10 publicly traded companies lose 50% of their value. And then other companies gain a certain amount of their value. And so the volatility is tremendous. And if you're looking at, over the next couple of years with some of this recession, inflation, US dollar trouble, banking collapses, do we really just want to throw in the market and let it rip and see what happens? No thanks, right? I don't think give money to a friend of mine, or loan it to them or invest in their fund or invest in their venture capital idea. than just, hey, let's put it in the stock market and let it rip. I think that's the message here. Finding the right deals, finding alternatives. There's a million different options out there. Where do you get access to this stuff? Where do you find deal flow? Well, sign up to go to Andy's event, go to Wealth Channel, go to the event, learn about it, sit through some of those presentations and pitches, and you're going to learn a bunch of stuff. You don't make an investment the first time, great. Come back the second, third, fourth, fifth event, get the education. I believe in alts. It's absolutely where we have most of our money. And I think it's something everybody must do. I was a financial advisor, Andy. I didn't tell you this. From 1997, when I graduated from college, I got my Series 6, 66, 63 life and health license until 2004, 2005. I was a traditional financial advisor. I used to charge fees to write financial plans. I used to charge a 1% management fee, all that type of stuff. And I was doing that in the middle of the 2001 tech bubble crash.
Wow.
How much control do you think I had over those client accounts when all of that tech was just absolutely imploding? So I learned my lesson very young, in my very early 20s, to love and approve and really invest in alts. I had that very real scenario, and you've had some very real scenarios yourself. So for my audience, that's my advice. Andy, as we kind of wrap up, what kind of final pieces of advice would you give the audience? Where do you think they should start? Where do you think they should do, especially over the next couple of years with all the volatility that we're going to experience?
Well, I think you have to educate yourself, right? So as passionate as I am about alternatives, I wouldn't tell anybody like just liquidate everything and just write a bunch of checks and be invested tomorrow without learning about it, right? So it is true, but I think this is true of all investments. You have to be willing to educate yourself. So invest in education. I mean, if you have a multi-million-dollar portfolio that you have, saved, amassed as a professional, as a business person with doing real estate, that's your money. That's your nest egg. No one is going to care about that as much as you do. So I'm all about having advisors, legal advisors. If you have a financial advisor, that's great. Tax advisor, I love my CPA, my tax advisor. I'm all about getting advice, but understand no one is going to care about your money as much as you do. So you can't just fully outsource the knowledge of investments. You have to be willing to learn yourself. My next piece of advice is if you have a particular passion in if you're attracted to, private credit, some of these yields are 10, 12, 14%. If you love that yield, if you're attracted to farmland, if you're attracted to multifamily, that's okay. You don't have to necessarily invest in everything. If there's something that you're passionate about, you're more likely to put the time in to learn about that asset class, and you're more likely to succeed, right? So we don't all have to have the same portfolio. To me, keep your eye on the ball, which is I'm not just after a portfolio, right? I'm after a lifestyle, right? I want to take care of my family. I want to live a life where I know that our future is secure. And so if you're keeping your eye on the lifestyle, not just the portfolio, then think about what kind of portfolio allows you to sleep at night. And whatever those asset classes are that you feel most comfortable with, I'd say invest in education in those. And then again, the most important thing is just get started. Don't let yourself sit on the sideline. I did that for too long, with real estate. I just kind of sat on the sidelines, watched other people invest. And finally, someday you just have to say, you know what? I don't care if I'm a beginner. I'm just going to start.
Fantastic stuff, guys. Shortcut to start. Go to Andy's website, wealthchannel.com/events. I'm on there right now on my other screen. They have upcoming events called the Alts Expo, the Wealth Channel Summit, and the OZ Pitch Day. Check those out, register online, and learn more about it, and then hopefully take your alternate investments to the next level. Andy, listen, thanks so much for carving out some time for us today on Accelerated Investor.
Thanks, Josh. I had a blast.
Hey, guys, hope you enjoyed that episode of Accelerated Investor. Man, I enjoy talking to guys like Andy because, I used to be a financial advisor. I was a financial planner. I know what the traditional markets look like, and it ain't good. People that sell into these different companies and mutual funds and stocks, and nobody knows if they're going to go up and down in value. How is it possible that a company like Amazon could go down 27% last year? How is it possible that a company like Facebook could lay off 20,000 employees after COVID, when they were just absolutely killing it? And all of a sudden, massive layoffs and stock prices down 25, 35%, and inflation's barking and nipping at your heels. alternate investments to me is one of my passions. So I had a great time on this podcast with Andy Hagans, the co-CEO of Wealth Channel. So if you enjoyed it, subscribe, rate, review, and like the podcast. I would be so grateful if you would do that. And we'll see you on the next show. Take care.
You were just listening to the Accelerated Investor Podcast with Josh Cantwell. If you enjoyed this episode and learned something new, help us build the AI community by leaving a review and 5-star rating on our iTunes podcast channel. Also, don't forget to subscribe so you never miss another episode. To see passive investing opportunities, visit freelandventures.com/passive. To start your journey toward the lifestyle you've always dreamed of with multifamily apartments, apply for one-on-one coaching with Josh at www.joshcantwellcoaching.com.